Welcome back. Now, Vukile Property Fund interim performance has outperformed guidance, leading to the company upgrading its full-year expectations. CEO Laurence Rapp attributed the results to a focused strategy, disciplined execution and strong operating platforms. He joins us now for full perspective of the numbers and the performance at large. Laurence, thanks so much for your time today. Now, just reflecting, right, on the 6 months that was, as well as the revised guidance, which of course doesn't come as much of a surprise as the group did hint at this in September. Talk to me about the factors underpinning that optimism.
Great. Well, thank you very much. I would say, three key drivers. Number one is a very strong operational performance in the first 6 months from both our South African and Iberian businesses. We expect that momentum to continue into the second 6 months. I think a second key driver for us was that the acquisitions we made in the last financial year have now been properly integrated into our platform overall. And that we've used this last 6 months to also start building up a pipeline of very exciting deal opportunities, which we hope to close on in the next 6 months. And then we've also undertook a capital raise in October. And we're now sitting with around 5 billion cash on the balance sheet. So not only do we have a pipeline of deals to execute on, but the funding already in place to do so. So I think a combination of those factors gives us the optimism that we're in for hopefully another good 6 months.
So sitting pretty when it comes to cash. And I'm wondering, when you mentioned those deals that you are in the process of locking, where SA sits, right? We are starting to see sentiment change. We had the S&P credit upgrade. We were removed from the grey list, and a more market positive budget from Finance Minister Enoch Godongwana. And we can't not mention the lower interest rates also coming through.
Absolutely. So we remain very, very positive on our South African exposure. I suppose a few months, about a year and a half ago, bought Mall of Mthatha, which we have turned around significantly. The team have done a great job there in growing that. I mean, our value on that asset is up nearly 40% since we bought it in May 2024. We have just announced a deal that we're acquiring 50% of Chatsworth Mall that we're hoping to have transferred in December. And we have another deal, which I can't give the name of yet, but that is currently in exclusivity and under due diligence, which is another township mall. So we remain very committed to growing in South Africa. Our malls do well. We've got a great understanding of the market. And to the extent we can find deals here, we are very happy to invest money at the right economics.
And we're seeing township and retail malls continue to outperform with near 6% trading density growth. Does this reaffirm township retail as, somewhat defensive when it comes to your portfolio? We can even put up the urban malls against this and what you're seeing on that side.
Sure. Look, there's no question township is our strongest segment in the portfolio. I think you've got a combination of a large volume of people. You've got dominance of our assets with very little competition in many of the places. And I think that always is a great position to be in. The urban malls do tend to face more competition with a more mobile consumer.
Yeah.
And have more choices, where to shop. But what we are very upbeat about in this set of results is that every one of our 5 segments, which is township, rural, urban, commuter centres and value centres, all showed growth in footfall and sales. So that has been a tremendous print showing all-round strength in our portfolio. And it's not just pockets of strength, but really everyone is performing well.
And it's also interesting to see a number of retailers announcing expansion strategies when it comes to opening stores. And I'm sure it's also filtering through to what's playing out at your malls. I want us to look at what's playing out in Europe then, Laurence. Iberian portfolio continues to outperform European averages. And I'm wondering how competitive their environment is for high quality retail assets. Also, are you seeing yields starting to tighten on that front?
Most definitely. So I think, if you look at real estate markets in Europe generally, I think Spain is seen as one of the most attractive investment destinations. That's across all sectors. Retail is popular, but not as much money coming in as people might have thought.
Okay.
So we have seen more competition for assets, there's no question. And we've also seen a tightening of yields, but it's not a deluge. So we are seeing more deals going to investment processes as opposed to getting assets off market. But our team has been working exceptionally hard there to find deals off market. The one we currently have in exclusivity, we secured off market, and that allows us to generally do better deals when we go down that route. Equally, the other pipeline assets that we're working on, we have secured off market as well. So, I think there are opportunities, but there's no question that compared to a year ago, it is a far more competitive market. Spain in particular, Portugal are really, really economies that have turned the corner. They're looking strong, they're looking resilient, and they're looking as though their growth is sustainable going forward. So yes, it is attracting more investors.
All right, let's leave it there, Laurence. Thanks so much for your time and just taking us through the 6 months that was for Vukile. That was Laurence Rapp, CEO of Vukile Property Fund.